Good afternoon. My name is Kris Saddoris, and I'm the group publisher here at Business Publications Corporation. Welcome to the third and final Project 515 of our 2022 series, which is being brought to you today by our presenting sponsor, Midwest One Bank, and our supporting sponsor, DLR Group. It's our goal to help you do business better, and you all are the reason we do what we do. This series is designed to help you in your business. Project 515 series of real estate and development focused virtual events that's going to dive deep into three specific subsections of the industry. We've already done retail, we've already done office. Today, we're here to talk about housing. The series has a goal of illuminating future challenges and trends throughout the year while amplifying discussions with the region's key stakeholders that do business directly in the sectors with those business leaders dependent on the health and vitality of the real estate industry. Coverage of today's discussion and past discussions are going to appear both written and in video form. They're going to be integrated across all of our platforms, both in print, our weekly commercial real estate e-newsletter, businessrecord.com, and of course our social platforms as well. We've got a great lineup for you today to peer a little bit in the future and to see what the housing sector is going to look like in 2023 and beyond. We've got a lot to discuss today, and we're excited to get going. But before we do, we wanted to take a moment to thank our sponsors that are making Project 515 possible. New this year is presenting sponsor Midwest One Bank, being represented today by Dan Kloop, Market President, and Randy Willard, Retail Market Manager. At Midwest One Bank, community is at the heart of everything they do, and since 1934, the bank has embraced taking care of their customers in order to help their customers and communities succeed. Today, we've got a brief video from Midwest One to help you learn a little bit more about what they all do.
I'm Dan Kloot, Market President for Midwest One Bank here in Central Iowa.
And I'm Randy Willard, the Retail Market Manager here in the Des Moines Metro. We are honored to be a part of this important conversation as we learn how to better serve our customers here in the Des Moines Metro.
Our goal as a community bank is to nurture and support our customers and those who should be, our community.
Like many businesses, the pandemic changed the way we worked through our mission, and we shifted our strategy to meet constantly changing demand.
On behalf of everyone here at Midwest One Bank, thank you for having us and please enjoy the event.
Thanks again to Midwest One for your sponsorship today and for helping power this series. This is still a relatively new thing for us. It's something that spun out of the pandemic. We're so grateful that we're able to keep talking about commercial real estate in this deep dive way throughout the course of the year. So thank you. Next, I want to thank our supporting sponsor, DLR Group, who's a returning sponsor from our first year in 2021. DLR is a leading integrated design firm located in Des Moines with offices around the globe and more than 1,000 plus design professionals. Their promise is to elevate the human experience through design, and I'm pleased to welcome once again Nick Hansen, National Mixed Use and Housing Development Leader at DLR Group. Nick, welcome.
Thanks, Kris. DLR Group's pleased to again be a sponsor of Project 515. As Kris said, we are an integrated design firm. We've established ourselves as a leader in design across multiple sectors, including multifamily housing. I'm actually down in Arizona right now for a conference all geared around multifamily housing. And yesterday, one of the things that we were talking about, the National Multifamily Housing Council's estimated that we are in need of 4.6 million housing units by 2035. And kind of diving a little bit deeper, in Iowa, it sounds like it's around 60,000 units. So with the growing population, low housing availability, it's becoming harder and harder to find and afford a place to live. At DLR Group, we are working with developers, landowners, municipalities to help make a dent into that unit deficit, having delivered 10,000 units over the past 7 years and an additional 13,000 units currently on the boards, ranging from high-end luxury to garden-style affordable housing. At the end of the day, safe, stable, affordable housing is something that no one should go without. I look forward to listening and learning from these experts on what they're seeing in the local housing market and what our local challenges are and how we can work together to make sure we have enough housing stock in our own backyard. Thanks.
Thanks again, Nick. We appreciate it, and thank you for your sponsorship. Your firm's handle on what's going on in this space is certainly appreciated, and I know it's something that our community has been able to benefit from. So thank you again for sponsoring today's event.
Thank you.
All right, we're going to get things going. Here's how it's going to work. In a moment, I'm going to introduce our panelists. We're going to ask a few questions to get things going, but you all have a role to play today as well in helping shape and guide the discussion. On the bottom of your screen, you're going to see a couple ways to interact with us. One, you can use the chat function. That's the easiest. Go ahead and use that if you'd like to submit questions throughout the course of the event. If you've got a comment you'd like to make, by all means do that. Our panelists may or may not interact with you. They'll do their best as they're trying to work through responding to questions, but we do use that as a guide to see what you're interested in and see if we can bounce off that as part of the discussion today. We won't have the ability to answer every question, so think about questions that, of course, could be a little bit more broad to the industry rather than very narrow topics. All right, we're going to dive in. As we all know, interest rates for 30-year fixed rate mortgages are climbing, making it more expensive for potential home buyers to qualify for loans. On top of that, the price of homes remains out of reach for an increasing number of potential buyers. In October, for example, the median sales price of a home in Greater Des Moines was $262,000, 12% above where it was just 2 years ago. Rental rates for apartments are rising and new home construction is slowing. All of this raises a variety of questions about what the immediate future holds for the residential real estate market. And of course, the residential real estate market is so intertwined with so many of the areas that we cover here at the Business Record. Kathy Bolton, our senior reporter, has assembled a great group of leaders from a wide variety of backgrounds to help dive into some of those questions. They've got expertise from a variety of areas. So with us today, we have Jake Anderson. He's a city administrator for the city of Grimes. We have Tracy Frette, senior mortgage lender at Lincoln Savings Bank. Nick Jensen, owner of Caliber Iowa Development. Kris Saddoris, vice president of development for Hubbell Realty Co. company. Jen Stanbrough, broker manager for Stanbrough Real Estate and president of the Des Moines Area Association of Realtors. And Carrie Werdeman, director of development at Kading Properties. Now, we've only got just under an hour here to cover a lot of ground. We're barely going to be able to scratch the surface of everything that's going on in the housing space. So let's get things started. Here to kick things off is our commercial real estate reporter, senior staff writer, Kathy Bolton. Kathy's going to be leading the discussion today. I'll chime in from time to time, perhaps with a follow-up question or two, but it's her show to run. Kathy, over to you for the first question.
Thanks, Kris, and thank you, panelists, for taking time out of your busy days to join us. We're going to go around the horn and ask everybody an opening question, and then we'll dive into more specifics. And the question's this: what one word or short phrase would you use to describe the residential market over the past 2 years and why? Jen, we'll start with you. Jen?
Looks like we might be having some audio challenges again there.
There we go.
It is audio challenges.
All right, so our full disclosure there is we were having some challenges with her early, and this was just turned out to be a unmute situation. So,
Which it definitely wasn't me. It was not me with the challenges. Technology for sure. I would say the phrase that I keep coming back to is always be changing. Over the last couple of years, we have definitely seen a changing market, and that can change from day to day, definitely month to month. We have had experiences where we were experiencing multiple offers and bidding wars and people paying cash more often than not, or waiving inspections. So I think just staying up to date on what is happening and always be changing.
Thanks. And Kris?
The word we've used with our team has been bumpy. It's the reality is we started talking about that in late in 20. I wish we weren't talking about it today. We still are, but we had to get to the point as a team that we were expecting that. There was always going to be a change. There was always going to be an issue. And I think it allowed our team to more quickly respond, certainly on both the development piece and the construction piece. It's just been one thing after another. And if we expected it to be bumpy, then we weren't surprised. And so, we had some good examples from our construction team that, we have a 5-story building downtown we're building that we've learned to build in a different way. Our property management people learned to lease apartments very quickly offline and, without contact. So COVID substantially changed and impacted everything that we do. Some of it, which is going to be with us for a long time. So bumpy's definitely been our word for the last 2 years.
Thanks, Kris. Jake?
It's been aggressive in Grimes and a little hard to keep up with, to be honest, from an infrastructure and planning perspective.
And when you say aggressive, describe that a little bit.
We've seen new home sales outpacing the production of developable lots.
So demand's outpacing what Grimes can be supplying at the moment.
Correct.
So, okay, got it. How about Carrie?
I would say on our end, supply chain roller coaster. So from challenges in obtaining lumber and siding at the start of the pandemic to windows when Windsor was blown offline with the December tornado last year. And now we're struggling to get electrical materials. It's just a real challenge to keep projects moving forward with an inability to get supplies. So that's been our big challenge.
Thanks. And then Nick. Nick, you're on mute. There we go.
Sorry about that. You got me?
Yep.
Yeah. So the word I would use would be unsustainable. Just with so much liquidity in the market, interest rates going as low as they did for so long through this last couple of years up until recently, just pricing hit just these new records with some materials also having their price increases alongside. And so the word I would use would just be unsustainable. And I think just recently, the last 3-4 months also feels that way, where things have slowed down and in many cases somewhat stalled out, and that's unsustainable as well.
Okay, thank you. And then Tracy.
Yeah, I would say the biggest thing is clients had to be prepared. I always recommend they do their due diligence when starting the buying process, but the last 2 years have added additional stress because of the increased competition for homes, changing interest rates, going up, going down, and change in home prices. Knowing what the client can do with the resources they had available has been a key to being able to navigate that changing market.
Okay, thank you. And then Tracy, we're going to stick with you. We know interest rates for home mortgages have doubled this past year, although today they came down a little bit, according to Freddie Mac. But there's an expectation that they're going to continue to rise. Sort of explain how the higher rates for mortgages are affecting potential buyers.
Yeah, higher rates have directly impacted borrowers' budgets because of the increase in the principal and interest part of their payment. For example, an average sales price of $250,000, clients with 10% down saw an increase in their principal and interest payments of about $475 per month. That's a change from around, $950 when rates were around 3 to about $1,425 at about 6.5. So those clients, if they wanted that budget to keep their payment the same at that $950, at 6.5, they're looking at about $170,000 home instead. That changed their buying power significantly.
So I assume that's pushing people out of the market, the home buying market. Who's being affected by that?
Yeah, I think the people that are being feeling the biggest impact are those with incomes below $50,000. Many first-time buyers with single incomes have been impacted. Even clients making $78,480, which is 80% of the area median income, and has been the limit for many first-time home buyer products, are finding financing a bit challenging. There are still and will continue to be low down payment programs. Those are readily available. Our underwriting guidelines remain flexible. Today, just more of our borrowers' income is being used for their housing expense, which obviously we see in rent as well. With the increased housing prices, with the increased rates, those two have felt like a double whammy.
Okay, so Jen, share with us sort of what you're seeing in the market.
First of all, one thing that I want to definitely stress is don't believe everything that you're hearing, especially in the national news. It has been pretty overwhelming gloom and doom the last several months. And we are seeing buyers still buying homes. We're seeing sellers who are taking that leap and entering the market and listing their homes. They are still getting under contract and pending. We're seeing even with a little bit higher interest rates, I would encourage my buyers to focus more on payment versus the actual pricing of home, and making sure that they are looking within their comfort zone of pricing. But, as Tracy was kind of mentioning there are many options and things that we can look at. I have more and more buyers that were talking about those adjustable rate mortgages, which sometimes are a little bit scary when you first hear about them. But I was meeting with a first time buyer buyer today. And we were talking about that option for her because this is her first home and she sees herself being there about 3 to 5 years. So, looking at an adjustable rate mortgage that we haven't looked at or used in the last several years is really coming into play. And again, just talking with buyers and educating them and making sure that they have those realistic expectations going into the market. One thing that has been nice is that now that we're entering a bit of a recovery phase, I would say, where we're back to overall an even market, not a seller's market or a buyer's market. If you look at the overall range, we just dipped into that. It's nice in that it's giving buyers a chance to breathe and to really take time throughout the process. They can come in and actually meet with a real estate professional. They can get themselves educated. They can explore houses. This summer we were going into houses and we may have 15 other people that were looking at a house or waiting on the doorstep when I was showing a house. And sadly, I had to tell my clients, if you want this house, you have to make an offer today because it'll be gone and we'll be in competing offer scenarios. And that led to a lot of stress buying, and they were making offers where they maybe didn't feel comfortable that they had had time to think through. And we were seeing a lot of buyer's remorse or transactions fall out because of that. So I think, overall, we have really great rates historically. We've seen prices come down just a little bit. That 260 that you're hearing for the median price last year, we were around 287, I think, earlier in the year for our median price in our metro market. So we've seen that stabilize a little bit. So all of that is to say it's still a good time to be investing in real estate.
So Jen, you and I have talked this past year about the lack of inventory in the market. Are we starting to see a little more inventory, or is it coming up because buyers aren't snatching things up as quickly?
A little bit of both. So the last market analysis that we had for last month, I don't have November's numbers yet, but we were at, actually, this is from Les Solgrove, who, if you don't follow him, he is great. He analyzes the statistics of our market daily. But we were at, I believe, 3.8 months of inventory on the market when looking at the market as a whole. That is great. That is a huge improvement from where we were, definitely. So buyers are having options out there. And again, that brings us into that even market. So we're not really seeing a heavy seller's market. We're not seeing a heavy buyer's market. And when I say 3.84 months of inventory, that means if we did not take another listing, how many buyers at our current rate of selling, how long would it take us to go through the listings that are currently on the market? And that's where we're at, that 4 months currently, which is a great place to be.
And it had been like 1.5 months to 2 months.
Yes, yeah. And in some markets, even lower than that, in some segments of the market.
Great information. Thanks, Jen. So Kris, tell us a little bit about some of the project Hubbell Realty has going on, and then let's just start there.
Well, we obviously Hubbell, we call it full house in-house. So we do everything residential, from the sales stuff that obviously, Jen's covered really well, all the way through. We do condo sales, and then we do basically everything rental. We do obviously some downtown, some urban stuff. We do single family rental, both urban, suburban, condominiums, and then we go all the way through the senior platform as well. So, 55 plus, both condos, and then all the way up through independent living, assisted living, and memory care. So, all of those are increasingly important pieces to Central Iowa. And, I'll emphasize what Jen just told you is, breathe. Everything you read does not apply to the Midwest. When we hear those numbers, those are national things. And yes, in Austin, Texas, rents are up 50%. They are not up 50% in Des Moines. So just breathe. But, we're in a good spot. But, the reality is, on the rental piece, we're at a 95% occupancy, which in our industry is basically, that's what we need in order to just turn units. And so, we are very full, as we continue to bring on. The challenge that we have, is just, we don't have stuff that's under construction. Right now there is one building that's under construction downtown, and I'll tell you, it's Hubbell's. So there will be a total of 100 units that will come online in all of next year downtown. And that's not enough. And so that's what I think the challenge is going to be, is that we're going to start to see, we need growth in housing. We need, we'll talk a little bit later, I'm sure, about some affordability challenges. But we just don't have units coming on. We need growth. When you see, our biggest industry thing we have across all of us, we'll talk about today is, labor. We have labor housing added. And so as you need lots of different options for housing in order to grow that. So the rental market's doing great, but we're going to need more units in order to grow and give options.
So Kris, talk a little bit of.
Yeah, Kathy, do you mind if I just give her one little context one? The 100 coming online, what does that look like in comparison to a few years? If you have, I don't know if you know it off the top of your head, but at least a ballpark on what that would have looked like.
I would say, we used to have 300 to 400, 500 coming online downtown. We just don't, as you want to grow those markets, you remember the days when you used to have 4 or 5 projects coming up downtown. You've got some stuff coming in Waukee, obviously Ankeny continues to be strong, and some West Des Moines, but we're just not seeing that, and it's because of all that stuff that, we'll all talk about, nickeling down a little bit costs and, because I always tell people, like, yes, rents are going here, but construction costs are going like this. The math doesn't work. So that's going to be the challenge for, I don't know how long.
So tie the higher interest rates with the need for more rental housing.
Well, and I think it goes back to just housing options. The reality is, the interest rates impact all of us. Now, certainly it impacts how a lot of folks come into housing, but, the reality is housing's not really a commodity. Housing for the most part tends to be a lifestyle decision. So you're typically making changes because you're making lifestyle changes. Very few of us just wait for like the great time and then suddenly decide to pick up and move. And so those interest rates impact all of us. And so, and maybe because I'm a moldy oldie, but the reality is we need to continue to offer lots of different options regardless of what that looks like. So yes, when rates go up, inflation's always our friend on the rental end, because our rental people have to stay longer because they cannot make the bounce over to the purchase. But that also means that we're not expanding, we're not opening up those apartments for people to come into our market. And so it continues to be challenges both ways. So it's good for us on the rental market, but I would say overall on a community market, we need to offer lots of different options, be that rental or for sale.
Good information. Thanks, Kris. So Nick, tell us a little bit about Caliber, Iowa, and what kind of demand you're seeing for both your rental and owner occupied projects.
Yeah, so Caliber builds a variety of residential products, both for sale and for rent. A couple of things we would have unique. There's a condo project in the suburbs that we're in the middle of building that we just brought to market for starting our showings about 100 days ago. It's a 24-unit building right in the center of Prairie Trail, which is a great place to bring on a product like we're building.
And Prairie Trails in Ankeny, if people didn't know that.
Yeah. And so over 100 days, we've been able to execute contracts on 13 of those units, which we are very excited about. The building's just starting to get drywall. And so I think that's a good testament to just a unique product and taking a risk in that lane being something that there's a buyer for and a demand. The homes that we build are mid to upper level. That product seems to still be moving and selling. I think the buyers for those that are coming in are able to put in more cash, have less of a loan. That interest rate doesn't impact them as much. I do think there's great local bank products for these buyers that are interest rate conscious, where they can get into some 5-year ARMs and still have rates in the 5 to kind of low 5 to mid 5% range. And townhomes, I say those, we've had some projects that have just been slow to deliver, slower than we had hoped, and commitments were made early. And something I would be able to attest to from just seeing these contracts happen and unknown close dates as they've closed, and the interest rate is much different. The buyers are still performing. They're still coming to the table and closing. So I think that's just a good testament to the buyer pool in general in central Iowa. On the rental side, Rents are very strong, just like Kris said, they are up. They need to be up though. Our assessments are up. The insurance costs have gone way up. And to do anything new, you're looking at a different set of a scenario as regard to your interest rate. The rental product that we have with a lot of townhome rentals, the retention rate has been good in our townhomes for a long while. We average about a 60-40 retention. So we're keeping 60% of our renters every year. And that number has increased to about 70-30 this year, which means that those renters are staying, they're not moving, they're happy where they're at. So I think in general, the rental market, and then we have some Class A rental product that would have heavy amenities, underground parking, that's filling up very well and renting well. But I think in general, Central Iowa is just so affordable where these rent rates are going up, they are higher, but as you compare to other markets, even just the Midwest markets that are a little bit bigger than where we're at in Des Moines, they're much more expensive to live in. And I think our rent rates are up, they're going to go up farther, but we're still so affordable that's going to be okay.
Okay, thanks, Nick. Carrie, tell us a little bit about Kading and some of the types of project it does.
Sure. So at Kading, we do development, construction, and property management of housing that is intended to be attainable for people at that workforce price point. So that is your demographic that's making anywhere from 60 to 100% of area median income. We refer to ourselves as kind of that middle income housing that's missing in a lot of markets that goes undeveloped. And so, the challenge that we have seen as interest rates rise, as material costs and labor costs rise, is kind of a sandwiching. We talked a little bit about what interest rates do to home buyers. We experienced the same thing on the development side in looking at construction financing. So we're starting to see where as our construction costs rise, the interest rates go up, debt service coverage becomes a challenge. So we have to consider finding ways of securing alternative sources of equity, whether that's through community partnerships or grants or alternative sources of funding, in order to bring down that loan to value level, because there's just challenges with meeting debt service at an 80% loan to value when we're trying to keep rents affordable to that middle income family.
So who have you been partnering with that maybe you hadn't in the past?
So we have seen a lot of different scenarios start to take place. So whether that be partnering with local municipalities on TIF or tax abatement increasing, or what we've really started to see is employers step up to try to help fill the gap. So especially in a lot of the smaller communities that we work in, there is no housing being developed. They really need housing in order to fill those jobs that they have available. So they're willing to step up and help with acquisition of land, or get very creative in doing rent guarantees or offer subsidies for their employees in order to buy down the cost of rent and make it affordable to their employees and still feasible to develop. So there's been started to really see some creative solutions in how to fill that gap.
Great, thanks, Carrie. And then Jake, sort of share with us what's occurring in residential development in Grimes.
Yeah, so it's slowing down. I'd mentioned earlier that permits have outpaced the production of developable lots. Last year we would have issued somewhere around 180 permits for single family homes. We're on pace this year to do half that. Mm-hmm. So it's slowed down quite a bit. And I think, a lot of inventory is part of that, but clearly construction costs and interest rates are drivers there too. We've got a number of multifamily projects that have been permitted, and a number of rezoning requests for multifamily townhome projects. So, we'd anticipate next year doing 375 townhouse multifamily units. There's been rezoning request for probably another 700 units in addition to that. But you know, the single family homes that we are seeing built are in housing developments where purchase prices are well in excess of $500,000. So I mean, I think, you know, we'll get some land opened up for a more medium house price, but for the most part, I think we're seeing more higher end development in single family homes.
So you mentioned townhomes, and I've been noticing in the building permits that there's been a lot of permitting for townhomes. Is that sort of replacing that your traditional single family house on a lot? What are you seeing there?
I mean, I guess I don't exactly know if it's replacing it. What's one trend that we have seen in Grimes is a lot more single family homes being renter occupied rather than owner occupied.
And how do you feel about that?
You know, that we've had a mix of emotions from residents about it. But you know, the city doesn't control every aspect of housing development, and it's hard for us to you know, in a community like Grimes with a lot of growth compared to some of the more outlying communities in the state. I mean, it's hard for us to participate with incentives for residential development. I mean, I think frankly, single family homes that are renter occupied is I mean, it's one way that we can meet the affordability challenge.
Okay, thanks, Jake. So one of the types of developments we're seeing occurring in the metro area, a lot of, and Kris alluded to this, is housing for older adults. We're seeing development of projects that allow senior citizens to age in place, and we're seeing development of both the rental and owner occupied housing for people 55 and older. So Kris, talk a little bit about Hubbell's Edencrest developments and what's prompting the need for them.
Yeah, thanks, Kathy. It's Edencrest has been a brand that we actually are in the process of constructing our 7th location in Urbandale that will open up, and we have 3 more under construction in Waukee, Adel, and Pleasant Hill. So I think a clarification, and I'm sure that Nick will talk about this. You know, we talk 55 plus. The reality is people don't turn 55 and then suddenly move into that. It's a federal requirement. That's the point that you can call it adult only, if you will. But the reality is the rental piece, you're typically in that 70, 75. And, you know, at our level where we do independent living, assisted living, and memory care, we're typically seeing you about age 80, 85. You know, we're living longer. Healthcare is allowing us that. So the benefits to communities, and that's why we get, you know, that's our favorite kind of housing for communities. They're super interested in that because it's one of the #1 things people are looking for. But it allows folks to stay in their community. You know, they love their community. They have friends there. They have church groups there. They have quilting groups there. But their single family rental or their single family home just doesn't fit them anymore. It doesn't fit their lifestyle. They may have challenges. So what it allows communities to do is turn that stock over. So, you know, that is typically a lot of times that's entry-level housing. It allows it to bring them in. And so I think that's what's important is that it allows those folks to not only stay in their communities, but it opens up housing in communities. So it allows, again, those first-time home buyers to come in because we can't build housing a lot of times at those price points. But we also know, you know, COVID taught us the lesson of that connections. You know, people need connections. They live longer. They do better with that kind of thing. And so it's a socialization thing. You know, what we build today, I always tell people, it's not your grandma's nursing home. You know, our Timberline project in Urbandale right now, we have a great deck that's outside. We're right at that cul-de-sac at 142nd and Douglas, if you've been out there. We have a big game TV in there. And there's a great big socialization. They have a bar. You know, if you go to Des Moines Golf, you have a little liquor kind of locker. We have those in there for these folks. So they're looking for lifestyle choices, but they just don't want to worry about the roof and the snow anymore. They want somebody there. So it's definitely that next step, again, for communities to offer lots of options for folks, and for seniors, it's a way to stay active in their community and open up other housing.
And the the developments that are completed, are they nearly full?
They are. We're seeing record levels of occupancy in all of our communities. The one in Timberline, I literally got calls when we were putting wrap on the building. And I'm like, folks, I don't even have any drywall in this building. So there's definitely a big interest. I think COVID taught folks that spending that time locked up in their home is probably not where they want to be. But we as developers have to represent that they're also not looking for the nursing home. They're not looking for those dark spaces. They're looking for active kind of opportunities. And with this brand, we've really built that kind of reputation in the community. And so as we kind of go into different locations, we're seeing some pretty strong interest.
Thanks, Kris. And then Nick Caliber's got some developments for 55 and older too. Tell us about them and where they're located.
Yeah, so we developed the lots for what's known as the EPCON communities. The EPCON communities have completed developments in Ankeny, Clive, and most recently in West Des Moines. We have new projects that have lots available in Waukee called Parkside, just north of the Northwest High School, in Ankeny up in Harvest Ridge, and a plat going in Johnston off 86th Street, which will have lots for next year. These projects are unique where it's active adult, all standalone, single family type living association homes. And so the houses are built in a way where the common area is all managed by the association. There's a clubhouse and pool, but you do own your own lot, you own your own home, and they are good size homes. And so they can be a variety of plans, but some of the story of half plans with basements can be upwards of almost 4,000 square feet. The product itself fits well in these communities. There's an average of the 80 to 100 homes. Starting price would be around 400,000, and there's units to sell over $1 million based on the plan you pick and what kind of lot premium you might have.
And most of the lots, Nick, they're smaller than your conventional size lot, typically?
Typically, yes. So we're looking for developments where we can have great surroundings and then create some unique lots within the development by making our detention areas into wet bottom ponds and create premium lots within the development. But your actual lot size would be smaller than an average single family lot.
And what's been demand like? Are you getting people interested in buying these? I assume,
yes,
since you have several going.
Yeah, so those three that I touched on first, those are all sold out, and we're just beginning sales in Waukee, and we'll have sales that start in Johnston. That the demand has been great. These buyers are looking for a no maintenance solution to home ownership. They're moving out of older, bigger homes, and the appeal of just neighbors that are your age into those similar activities. The clubhouse, the associations take those over. They operate a number of events within the community, and the connecting with your neighbors, similar to what Kris touched on. This would be different where you're owning your own home, but to offer that option for the demographic seems to be received very well.
Great, thanks, Nick. And Carrie, Kading has some housing for senior older adults too. Tell us a little bit about those.
So Kading doesn't actually develop housing that is specifically only for 55 and up, but looking at our portfolio, about 20% of our leaseholders are over the age of 50. So what we see within our community is everything that we build, with a few minor exceptions, almost everything that we build is zero entry. So it's slab on grade zero entry, which means that there's no step up in the threshold, either from the attached garage or entering through the front door. So what that means is that we're really conducive to the folks who are, maybe starting to have mobility issues or worried about needing to step over. And so we really do attract that 50 and up group, the empty nesters, who, as Kris mentioned and Nick mentioned, are ready to not deal with the lawn and snow anymore. Maybe they want to, we're all rental. However, it's the same, group of people or lifestyle choices. So maybe they want to go to Arizona for 3 or 4 months a year, and they don't want to deal with the maintenance on their home while they're gone. And so we do see a lot of that. And just like Kris touched on, the biggest advantage that we're excited about that aspect of our developments for the communities that we're in is that it really does open up that housing stock. That's more of that entry-level housing stock. We can't build houses today for $150,000. So the only way that we're going to make houses available for purchase at those entry-level price points is by opening up existing housing stock. So not only does the mix of our 50 and up accomplish that, but also it helps to build that village or community feeling, to have that mix of ages across all of the developments. We see that helps fill even things like the childcare gap in some ways. So we see after school childcare being provided by an empty nester who lives in the community, who is willing to take in the kids for a couple hours after school. So it's really fun to see how that age and demographic mix can have a positive impact on the overall community.
Okay, thanks. So Jen, as we see the price of a traditional single family home get out of reach for potential buyers, what options are available for them besides renting?
Besides renting, we are seeing people looking at townhomes depending upon their lifestyles and their wants and needs. Part of it is still going back to that being prepared. I'm seeing buyers really start the process of educating themselves and meeting with professionals up front so that they're getting more prepared as far as saving more for a down payment, which is making some of those homes, it might take them a longer to get prepared to make an offer, but they're still able to then enter into the housing market when they have saved up that down payment. And again, like I was talking about earlier, looking at those options as far as buying down rates to make their payments more affordable up front, adjustable rate mortgages. We kind of got a little bit bland and vanilla in what we were doing over the last few years when it was really, really good. I mean, everyone was looking at a 30-year fixed market, and that's all fixed interest rate. And that's all that we have been looking at, and kind of the same for our real estate. We're really having to kind of dig into that toolbox and pull out some of the tools that we maybe haven't used for a while, and just again, get back to really talking to our clients, asking them what their goals are, kind of where they're at in their life, and really kind of walking alongside them. We've had a huge growth in the number of real estate agents that have entered our market. I believe we're right up around 2,500 right now that are licensed real estate agents in the metro market. And I think we are going to probably see that turn a little bit more, as it's going to take a little longer. You're not going to necessarily show a house and write an offer. You may be working with people on average 6 months to a year instead of 2 to 3 months. And that's going to be a change, but I think it's a welcome change of really getting back to the basics and taking care of people.
Great, thanks. And then Tracy, I want to jump to you and to borrow Jen's phrase. What sort of tools are in the toolbox now that maybe you hadn't been offering for financing new homes? What are you seeing more of?
Yeah, to echo what Jen said, is we have definitely found a return to adjustable rate mortgages. Clients are much more equipped to understand how those work, as well as clients looking into temporary buy downs, temporary interest rate buy downs, as well as permanent interest rate buy downs. The Iowa Finance Authority has just announced an expansion of their HFA products to open conventional financing options to higher earners. They provide, through that agency, both a grant and down payment assistance programs to buyers who qualify. We use the Federal Home Loan Bank when they have their down payment assistance available. Just every single possible option we can find to help clients meet their needs.
Great, thank you. So I'm going to jump a little bit forward here and talk about sort of what's on the horizon for 2023. Jen, start with you. What's your crystal ball say?
Well, again, you know, my friend Les Solgrove, I watch what he's doing because he has it down to a science of pulling our data, and he has a great way of making it easy to understand. But, you know, we have real estate cycles just like anything else. And I think we have already started to see that slow down as you're looking at just getting back to an even market. That shows the slowdown, having prices, even that decrease in median price from 283 earlier this year to 260. We're starting to see that. I think as we go into 2023, echoing what Les was saying recently, we are kind of entering that recovery process where we're going to have less inventory on the market. Again, part of that is just with part of the supply chain issues that we have seen in new construction, and new construction still being delayed or just not having as many options as we have in years past for new construction. We've had a lot of people over the last couple of years sell their existing home. We've also seen that kind of COVID effect of people are using their homes differently. They're also living their lives differently. So I know I personally have had a lot of people moving into the Iowa area because now they can work from home, and that gives them flexibility where maybe they were California based and now they want to get back where they can actually afford a home that has a yard and a garage that's attached, and they're super excited about that. Or people moving back to be closer to family. I think we've seen a shift. I think we'll continue to see a shift, and I think it'll be kind of exciting to see what happens in housing and how that is adjusted, because I have several families that 2 of them are working from home now. And so now you almost need 2 dedicated office spaces, which is something that we really haven't had in the market again. But I think we're going to stay strong. I think we'll see a little bit of a dip, but I think that, you know, the end of 2023 into 2024, there's always going to be people buying. There's always going to be people selling. I kind of joke that there are death, divorce, babies, marriage, job changes, and that's always going to keep it moving. It's just going to not be what we have been used to the last couple of years, but that was really an anomaly. And if you look at history, that has not been representative of path of home buying in over the last several decades.
Okay, thanks. So Nick, you've talked a little bit about the prices of materials going up and down and around and everywhere else. What do you anticipate for materials pricing for 2023? Is it going to ease at all?
I sure hope so. It's been a real battle on shore. You know, I see things are leveling already right now on the material and labor front, and some things are certainly going down. Lumber's down a good chunk, which is great for that being such a major component of the build. You know, 2023, as I think about that, it seems like a lot of people right now are just asking themselves or other people, does this most recent slowdown feel like 2008, 2009? And that's something that's just being discussed quite a bit. I don't think, you know, as you look at the local builder developer profile around Des Moines right now, it just feels very strong compared to 08, whenever a majority of the home builders and developers within a year of a slowdown were out of business, shut their doors, and it really put a big quick dent in the market where banks became the biggest builder developers in town, and they had to make big discounts, and you had the subcontractors that just got totally taken out at the knees by not getting paid on jobs. And it was a really tough time. And as I think about next year and this most recent slowdown and just look at the local builder developer community, I think the subs will all get paid, so they will stay in business. I don't think banks are going to be taking things over. As you look at the vacant land around town, the biggest holders of that land now are people that don't use banks, and a lot of them don't even have their income through real estate. So I think that all feels really good. That maybe touches more on the labor side of just the subcontractors, but I do think there's going to need to be some natural regression where land is going to get bought for less, and subcontractors are going to have to work for less, and materials are going to have to go down in order to build and sell homes and build rental product. So I'm very hopeful of that. It's just a natural regression.
Okay, thanks. And then, Kris, what do you think on the horizon for Hubbell? Will Hubbell be starting new projects in 2023, or are we just going to sort of hold steady?
No, we are, it's, as I think everybody's talked about, it's tougher. We have a project, we just started out, we have a single family rental project called Rialto that we're doing in Waukee. We are just grading on it right now. It's the first time we'll big some rooftop units, outdoor patio, rooftop housing to the Waukee. We call it levers. Everybody's pulling a little bit on this lever, a little bit on that lever. And all of that is going to be required to get deals done. Yes, they're going to get done. They're just tougher, and you just have to focus on every little thing. Every little thing makes a difference. We have sliced and diced those units to death, I will tell you, within our team, but they're going to go. And we had phenomenal response from our investor pool on them. So there's still a strong interest in Central Iowa, but it takes a very good experienced team to get them off the dime. But yeah, no, we've got several kicked off. We have a full pipeline for 23.
Great, thanks. And then Tracy, national experts are talking about interest rates that could surpass 8% in 2023, something we haven't seen since the year 2000. What are people you talk to saying about that?
Yeah, well, I would love to have a crystal ball to answer that question. When experts predicted this year's rates at the end of 2021, they had thought we would end 2022 around 4.5, and that clearly did not happen. We are above those expectations. Many people think that when the Fed raises their borrowing rate, that mortgage rates move in direct correlation. The fact is that many factors affect mortgage rates: economic data, inflationary pressure, the stock market, geopolitics, as well as other global events such as natural disasters, the war in Ukraine. The Mortgage Bankers Association has projected rates to moderate in Q1 of 2023 to around 6.25, moving back down through 2023 into the mid fives towards the end of the year. So I'm really hoping that the Mortgage Bankers Association's predictions hold true.
Okay, well, thanks. I know some of our guests didn't get their questions answered that they posted in the chat. We apologize. We had such good information, we couldn't get to that. But we'll try to circle back to some of these folks and pick their brain and maybe write about it in the future. So thanks, panelists. And Kris, back to you.
Great. Well, we're just about out of time. We'll give each of the panelists a chance to give one quick final thought here to leave us each with today. But we want to thank, of course, each of you for participating in the panel today. If you enjoyed today's programming and you want to dive deeper, and obviously we could just barely get to some of the topics today, Kathy's going to, of course, be writing about this and writing about all angles of housing as we move forward. The best way for you to learn about what's going on with commercial real estate is to be signed up for a commercial real estate e-newsletter. That comes out on Wednesdays. It's free. You can sign up at businessrecord.com/sign up. If you enjoyed today's event and you're interested in attending some of our other things that we do, both virtually and in person, we've got a number of things coming up. On January 6th, our 2023 Book of Lists unveiling, that free event at the Capitol Square in downtown Des Moines. Great event to kick off your brand new year. It's on January 6th. We'd love to see you out there. Registration is now open for that. On January 10th, our legislative forecast event, that will be a virtual event. We'll have a panel of experts that will talk about business issues that are going to be in the legislature this year and what you might expect the legislature to be doing in that space. And then on January 24th, we will be opening up, our January 24th, we'll have our economic forecast luncheon at the Sheraton West Des Moines. Ticket sales will be going on sale for that here in a couple of weeks, and corporate table sales are now open as well. In addition, our annual real estate magazine that came out this past April. It's the 6th edition of that product. There's a ton of great information in there. That's good evergreen material that I'm sure you'd be interested in checking out. You can learn more at businessrecord.com/annual AREM. If you're interested in getting a copy, all of our members each year get that. We're already working on next year's edition, of course. Kathy's working on that as well. If you're interested in supporting the publication, you can learn more by clicking on the link that we'll throw in the chat here for you to learn a little bit more. I already mentioned Commercial Real Estate Weekly. That's the best way for you to really stay connected with what's going on. Kathy does a great job. We're so fortunate to have her working on that each and every week. And of course, if you have any feedback, if there's any story ideas, things that you think Kathy should be writing about, please feel free to reach out her way. If you're interested in supporting Project 515 or our other initiatives in the space, please feel free to reach out my way as well. All right, back to our panelists for a final thought. Please keep it nice and brief, just like we did on the round, the way down here. So why don't we go ahead and start with Nick?
Yeah, so final thought I would have, I guess, is be prepared, kind of touching on what Jen started with, is this year in the whole started one way and it's ending very differently. And so I think that's a good mindset to have and looking forward at the year ahead.
Great. Jen?
Again, just reiterating to make sure that you're actually talking to experts or professionals in our market and taking the information that you're hearing maybe nationally with a grain of salt, because we are really blessed to live in the Midwest and have a lot of opportunities here and great prices and many people that'll help you out.
All right, Jake.
Grimes has made significant capital investments in infrastructure to try to be development ready. So as you know, and we put a lot of effort into making our permitting and regulations predictable for the development community. So I think we're in a good position to be quick and nimble as the market changes into 2023.
Great. Carrie.
Agility is key. So I think we've all talked on different ways that we've worked to stay agile with regard to materials and labor. If we can continue to be agile and communities can be agile in what they're willing to consider for facades and finishes and things like that going forward, then we can really keep the focus on housing affordability for all.
All right, Tracy, and then we'll wrap with Kris.
Sure. I'm optimistic about the future. I've been in this business nearly 30 years, and we continue as an industry to pivot. I believe people will always need housing, as Jen said, and it's our job to make them navigate or help them navigate the pitfalls and provide them with the best advice and opportunities that we have available.
All right, Kris. Wrap us up.
I'll lean into Carrie's comment. You know, cities that understand they are in partnership with us and can be creative in looking at housing will be successful. We have a great example coming up right now in Des Moines. We have our first ADU unit, which is coming up in the city of Des Moines. It's a partnership through Home Inc. and AARP that, again, is adding density, gentle density, very unique way. The city of Des Moines has been fabulous supporting that. And so I think we have to think creatively to add housing in very unique ways.
All right. Well, again, I want to thank everybody for attending today. As a reminder, we're making this series free and available to the community thanks to the support of our sponsors, Midwest One Bank and DLR Group. And we too are a locally owned business, and we're working hard to navigate through the rising interest rates and rising costs as well. And you can help ensure that we can continue to bring you that quality reporting and events like this into the future. Sponsorships and advertising from companies like Midwest One and DLR Group make what we do possible. And so we, of course, would appreciate if you're interested in getting your message in front of the development community. Please feel free to reach out my way. And if you're not already a member of the Business Record, we encourage you to support the Business Record by subscribing to our products at businessrecord.com/membership. You get the weekly Business Record, insider coverage, and of course, invites to events like this. Also, I want to give a big thank you to Kathy Bolton for putting together a great group of panelists today. As you saw, we could barely jump into all the aspects of what's going on here today. I'm sure she'll be working on a variety of stories going forward. And of course, to our speakers, we're so grateful for your expertise today and your forecasting abilities. Thank you for putting yourself out there today, helping us peer a little bit around the corner into 2023 to see what we might expect in the housing market. If you could in the chat, give them a big thank you as well for giving their time and energy today to help us all understand the community just a little bit better. Thank you again. My name is Kris Saddoris, and we're here working hard every day on Project 515 to help build and strengthen the community. And if our staff or I can ever be of any help to your efforts as you continue to build your business, please feel free to reach out our way. Thanks again, and have a great afternoon.